Hi, good afternoon, everyone. Thank you so much for being here. Lovely to have you all on a Saturday afternoon. My name is Teresa. I head the entrepreneurship vertical at Idobro Impact Solutions. And twice a month, we bring you LinkedIn Live to get some answers of questions that we are not able to answer in our regular programs. So, my name is Teresa, again, like the tree, and I have yet another episode of some really important questions that we will be getting answered soon with a special guest today, Mr. Sathish Ramalingam. He's top 10 virtual CFOs in India as per 2022, and he's also a multipreneur, which means that he's co-founded multiple companies. Currently, he's the CEO of a company called eAuditor Office Private Limited, which takes care of accounting, auditing, taxation, advisory solutions, and also precaution provider to startups and entrepreneurs and all around the globe. To be very honest, if you have seen his LinkedIn profile, he has been posting so many amazing insights to the sector, giving you heads up on what kind of compliances you should be looking at, and doing just wonderful work in the realm of startup worlds. So, Satish, thank you to you. A big thanks to you for being on this platform, and really lovely to have you here.
Thank you, Trisha. Thanks for your
Uh,
introduction.
Thanks, Satish. So let me just dive in. We've already lost few valuable minutes. I will start with the first question. And I think startup valuation is such a sought after topic in all our programs. And all of our entrepreneurs have this question that when should we start looking at company valuation? What is the right stage to initiate company valuation as a founder? So let's start with that.
Okay, so first of all, before looking into the valuation, there are few stages in the fundraising. First one is pre-seed round, seed round, and post-seed round, bridge round, series A, B, C, D. So first we have to look whether you're going for which round. So if you are starting now or you are raising fund now means it will be a pre-seed or seed round. So for that, immediately you don't want to jump into your valuation report. Okay. So first, build your product and MVP, find your target audience, and build a distribution channel to reach the target audience. Then make a sample sales or service. Find your product mentor and finance mentor. Then start finding your investor with a basic pitch deck. So once the negotiation is in the second level or third level, then you can think about the valuation report.
So next important question is that a lot of companies who don't even have assets. There are no factories, there are no like manufacturing units, there are no assets. They also tend to evaluate very highly. So are there non-financial or non-tangible factors such as team, the founder's experience, or the business model or the brand that plays an important role when it comes to valuation of a company?
Okay. So how the valuation works is majorly based on your future 3 year, 5 years of financial projections, like P&L, balance sheet, and more importantly, cash flow statements. So based on the future 3 years to 5 years projections only, we will evaluate the valuation of the company. That's why so many startups who doesn't have a revenue or doesn't have a asset is showing that much of valuation.
Right. So if a company does not have, say, a positive cash flow, then how do they how what is the method wherein they show that they are a highly valued company, or in future that they would make so much money? Like how does it work?
Okay. So present status might be a negative cash flow, but in future they will show no. Once this, for say for example, they are raising $1 million means if they are bringing that $1 million and infusing into this into their company means definitely their cash will become positive immediately, instantly, because they have cash. So using that cash, they will do marketing and develop their product. and make more sales, buy some assets. So month on month, their business transaction will increase. Eventually, their cash flow also increases. That's why I'm telling, based on their future cash flows only, the valuation happens. I can just quickly share a document how a valuation report looks. This is a back end working what we do. Okay, what you see will be a different one. Okay, I hope everyone is able to see. Just type in the chat whether you are able to see. This is what I was telling. The D column is actual, and the remaining are the projections: year one, year two, year three, year four, year five. So this is the income statement you can see. Then we will put the balance sheet: actual and year one, year two, year three, year four. Then fixed assets. So presently they don't have assets, but in future we made assets because using the investment, we are going to buy whatever investment comes, and so we are preparing a cash flow statement using this. Then we are arriving this value of the equity. So this highlighted in yellow, no. So to arrive this only, we are going to do all this process. So
I
this
think
is how
in
it.
this is the sixth episode, not this is the first session where we are doing a very practical hands-on
Yeah.
visualization of what kind of valuation looks like. So thank you, Satish, for this prep. And now I think our audiences know, and even our future audiences know, that based on the investment that you're going to take, you will make a projection, and based on that projection you can raise funds for your business. Okay, so
Yes.
I will very quickly deep dive into a very critical question that everybody asks. Can you share about the valuation? Are there specific methods that people or investors use for
Yes.
valuating businesses? And what are the common ones that startup founders should be aware of when it comes to these methodologies?
It's a commonly used method in India and across the world is discounted cash flow method. So I showed one document, no, using the projections, we arrive the future cash flows. The future cash flow, how we arrive is the funds, what we are going to raise, no, if it comes now, what will be our future cash flow. Based on that only, we will do the discount valuation based on the discounted cash flow method. That is the majorly accepted method. And in few instances, only the minimal instances, based on their net worth, they will give, they value in the 2x or 3x based on their turnover, 2x or 3x. So most of the time, discounted cash flow method. That's it. Very simple.
Okay, I think this session is all about simplifying everything. So,
Yes.
to all the founders, if you have not made note, do understand the methodology. I'm sure there are tons of tutorials available to decode this further. Use the discounted cash flow methodology for valuation, and that is what commonly is used. If you have more questions for Satish that you would like me to take up and ask him, please send it in your comment section. After the next question, we'll be looking at any question that have come in the comment section. Yeah, okay, let's move ahead. So I wanted to check with you on what are the biggest mistakes that founders make when they are presenting their valuation to a potential investors, and how do these startups avoid these mistakes?
Okay. So very important question. Okay. So first, what they do now, so they will create a pitch deck, and in pitch deck, 2 to 3 slides will occupy the valuation data. Okay. So majorly, the founders who is going to pitch in front of the investors will focus only on the pitch deck part, and the valuation part they will just focus only on the valuation amount alone. They won't involve in the entire valuation process. So due to that, whenever the investor raise any questions, the founders won't be able to answer. So they will ask, so what is the EBITDA? Why EBITDA is negative? So why the marketing cost in year two is this much? Why in year four it is not that much? Like that, they will raise questions. So in that time, they won't have a right answer. Then they will get caught at. So they don't know about their business future cash flows because they are going to invest money for the future activities only. So all the founders should know each and every numbers, whatever mentioned in the valuation report and the projections also. Okay. Otherwise, it's going to be a bitter day for you.
Thanks, Satish, for the heads up. And I think we all agree that when it comes to finances, it is people just assume it is very complicated and they don't want to. They're so busy in the operations that they don't really pay attention to their P&L or even their projections. And even though they would like really memorize some of the numbers, but yeah, paying attention and being completely involved in your projection process is very, very crucial with respect to raising funds. So very valuable tip, and thank you for the heads up, Satish.
Yeah.
Okay, let's move on to the next question. How are you handling valuation of a startup that generates minimal revenue or isn't still pre-revenue phases? So is there certain methodology that you use or certain advice that you give to the founders that you work closely? Is there some tips that you can share?
Okay, how we start is, say for example, you are starting a drone company. Okay, so you and your partner. So first we will have a initial discussion. Okay, about your company and about the founder's background and everything. Okay, even before fundraising, before funding, the investors will do the due diligence of company as well as the founders also. So we will have a detailed discussion and all your future business activities, what are you in your mind, okay, for the next 3 to 5 years. We will discuss. After that, we will give a checklist, okay, for the future transactions, whatever amount. For example, for rent, how much you will pay, salary, in year one, how much, and year two, how much, year three, year four, year five. You have to fill those things, okay. And also, if you are a 1 year or 2 year old company, then you have to provide the data, whatever transaction happened in your company, including the bank statements, P&L, whatever, okay, from the day zero to till today, we will collect. So after collecting all this data, we will logically, we will craft the projections for the next 5 years P&L, for the next 5 years balance sheet, and next 5 years cash flow statements. Okay, in this entire process, we will have at least 4 to 8 hours of discussions with the founders. So, out of 100 projects, at least 20 to 30 people will reiterate their business ideas because they come to know definitely that idea is going not going to happen, because this is what we experienced in our past 5 years valuation. So after the 5 to 8 hours of this discussions, we keep on iterating the entire projections, and once it is finalized, we will proceed for the valuation calculation. Once it is done, we will prepare the valuation report and provide it to the startup founders. So the time period is minimum 4 to 6 weeks. If the turnaround time of the from the clients, from the founders, is less than 24 hours. If it is beyond 24 hours, even it will take 6 months also. It purely based on the founders' response.
Satish, I love how practical tips you're giving to all the listeners over here. And it's a very practical timeline. You're also giving disclaimers. If it is 24 hours of turnaround time, then it will happen in 4 to 6 weeks. A supplementing question to this is once all of these documents are ready with respect to, pitching to an investor and say in principle, investor agrees, what is the time duration from the investor saying yes to actually the startups holding the check? Would you be able to share any insight around that?
Yeah, definitely. So this entire process, fundraising process, will take a months. Okay, but if the investor says yes, means in few weeks they will just sign and give the check, because presently in 2024, dry powder is more with the several VC firms. Dry powder means non-disposed funds are available with them. Okay, so they are looking for the potential startups. You have to underline the word potential. Okay, so if there is a right startup, in a few weeks they will definitely give the check. And once the
Okay.
check is, yeah, please, once the check
No,
is
no, please go ahead.
received, yeah, once check is received, we have to immediate, because in 4 ways they will invest, either in equity mode or CCPS, compulsory convertible preference shares mode or CCD, compulsory convertible debenture mode or iSafe. Either of the four mode or mixture of the four mode, they will invest. Once the fund is transferred, we have to immediately do the ROC compliances, and we have to provide the respective certificate. If it is equity, if it is preference shares, then preference share certificate. CCD means debenture notes, and if it is iSafe means iSafe agreement we have to provide.
Right. So maybe this period of time is an exceptional situation because of the funding winters that happened last year. But my question to you is, there is the whole process of due diligence, right? And somebody who is taking a service from a professional company like yours, maybe it is easier for them to provide the data. But what about other kinds of, startups who do not have, a service like your easily accessible, or are not taking up a service for them? The due diligence process, what are like the common mistakes, or what is the time period like? Can you just walk us through these different steps?
Okay. Okay, great. So there are two types of due diligence happens. One is self due diligence. Before going for the fundraising, if a company is 2-year old or 3-year old or 5-year old or 10-year old, they should do self due diligence. That is nothing but full body checkup. How we do know for a human being, like that they have to do. Otherwise, they are directly going for the investment means the investor will do the due diligence, not the founder. The investor will appoint a service provider like us, and on behalf of the investor, we will do the due diligence. I will quickly show the a template of a due diligence checklist. So I hope it is visible. So this is the due diligence checklist. They will ask for the historical data like last 2 years or 3 years financial statements, and all the MOA, AOA, income certificate, DST returns, bank statements, all the transaction, and if you have IP or trademark, those certificates, and any insurance made on behalf of company to its company or employees, all the compliances, FDA things, any litigations, technology, what they have. So this is the brief idea about the checklist of the due diligence.
That is a very extensive list. And with respect to this due diligence list, is there any way that startups can start preparing to put this list together? Are there any resources, or are there any ways that they can start doing, like ease out into this process?
Okay, I have a so very simple. If any startup is going for a fundraising, okay, even if they have a wonderful scalable business and a wonderful team, okay, the investors will see their compliances, financial discipline. Okay, they should make sure the all the compliances, day-to-day compliances are done on time. ROC, GST, TDS, income tax, and ESIPF, whatever applicable to that company. Second one is for fundraising, the private limited is the only legal entity which is eligible for the fundraising. Okay. Third one is you have to keep your P&L balance sheet in an accurate way. Okay, that is the important thing. If all these three things are done, then eventually your business should be good, and you should have a good team, and especially the founders should have a good profile. Even their CIBIL score will be reviewed by the due diligence person. The logic behind checking the CIBIL score is very simple. So if the founders, any one of the founder is having a debt, and the bankers are just chasing them, what happens if the investor invests in the company for so the investment will be a raw resort for them. They will take that money and they settle the bank loan. That's why they are checking the founder's CIBIL score also.
Great. I think founders' CIBIL score is not something that our founders are currently thinking of when we are thinking about raising funds. But I think this is an excellent tip. And there was a long list of compliance that you shared. So one of our audience members is asking, would you be sharing the templates? Do let us know if you would be. I Anybody who wants any kind of template, or anybody has
Uh,
any, yeah.
yeah, sir, please continue.
Yeah, anybody wants to request anything, we would suggest that you send Satish an email directly to info@eauditoroffice.com, and we will leave this email address on your comments. If you have commented, you will receive this email address. You can send it to them with the subject saying requesting fundraising session document, and in the body of the email you can write name, company and designation, introduction about you in 2 lines, and for mobile number. We'll leave these instructions for you on your comments. So if you want the templates for fundraising, for understanding the compliance processes, please send a message on the please share your comment on the live LinkedIn video. If you're watching it, if there is any delay in this in watching, you can still leave the comments and we'll get back to you on that as well. Okay, so over to the next question. I think this is a very interesting question because till now we were talking about all internal factors, everything that was in control of the founders. But what about the external factors? There is market changes, there is political changes, there is regulatory changes. So what role do they play when it comes to valuation of a company? Is there Do they influence or not?
Wonderful question. So, how the founders ignore the financial department, likewise, they ignore the political and regulatory authorities also. So, so, whatever sector you belong to should closely observe and check, keep on checking the regulations. Okay. So, say for example, recently the RBI have given a guidelines for the fintech companies. So if anyone is coming up with a hardware kind of thing, like how Pine Labs is doing, no, some that card swiping machine like that Pine Labs is doing. They are a kind of a fintech company. So if any fintech company is coming up with the same kind of idea, or even the existing companies should have at least 25 crores of net worth in their balance sheet. So for startups, it is a bigger thing. They can't pool that much of net worth in their balance sheet. So this is a turn off for new startups. So even if any startup is in the process of setting up those kind of services, so it is going to ruin their dream unless and until they bring that much of fund. So please keep an eye on the regulatory authorities and political things related to your sector. Energy means energy related regulations. Insurance means insurance related. IT means IT related. Okay, so you have to keep an eye.
So external factors definitely play a huge role,
Yes.
and keeping an eye on the sector related news is far more important uh, when it comes to valuation of the company. Okay, we have some questions started rolling in. Let's take a question from Mayuri. She's asking, what are the common mistakes founders make when negotiating startup valuation and how we can avoid it? So I
Okay.
think this is related to something that we have already answered. But if you can quickly touch base, and if there is any gender angle, like with respect to men versus women when it comes to negotiation, because in our experience we realize that women negotiate very differently from men. So if you have any insights, do let us know.
It's okay. So any founder, what they do know, they won't take help of the professionals who have expertise in this numbers and negotiations. They will directly jump and they will just do negotiation. So that they should avoid. They should hire some virtual CFO, or they can ask uh, the person who did valuation for their company to accompany. They can pay for the hourly basis or any professional fees. So you have to accompany any professional who is having expertise during the negotiation.
So you strongly recommend that they should involve a professional service
Yes,
provider, and they should have for negotiation also somebody who has the knowledge and experience of doing valuation and negotiation with you.
yes.
But the question
Professionals
is,
who is having expertise.
expertise. Okay, not just experience, but also expertise. Okay,
Yes,
got
yes.
it. So there are some questions coming in, but I don't think they would do justice to your time and knowledge. So I'm just going to move on to my question, which is, do you have any specific resources or any specific tools that founders can utilize to better understand the startup valuation even before going to an expert, or even before going, they would need to do the scope of work, right? Or if they cannot afford an expert, then what kind of tools or resources that are freely available that founders can use for startup valuation or just to get started?
See, for startup valuation, there is no separate tools. They should know what is their next 3 years or 5 years pendings, earnings, assets, what are they going to purchase. So all these three things they should know clearly. They should write down for the next 3 to 5 years. So these are the basic things they should get ready with.
Right. So just getting a hang of the concept of valuation, the method of valuation, and knowing your own financial numbers in and out is a good prep for a startup valuation process. Thank you, Satish. I think this has been really amazing. We will take one last question from the comment. And if you guys, if you have more questions, and I know that there is a little bit lag of when we are saying and when it is getting live stream. So if you have more questions, leave it in the comment and we promise that we'll get them answered from Satish on an email and paste it back again the comment. We have a question from Muthu Kumar. He's asking how much equity can be typically diluted during Series A and subsequent round of fundraising?
It totally depends upon their how much they diluted in the seed and pre-seed. So series A onwards, it's purely based on the valuation only. Maybe series A, series B and all, valuation might not play a bigger role. Okay, but for series, purely based on the valuation, we have to dilute. Say for example, your company is valued at $100 million, means you are going to raise 2 million, means it's easy. 2% you have to dilute. If you are going to raise 10 million, means 10%. So based on the valuation only, Series A, Series B, Series D will happen. So and also what is the percentages depends upon the, so what is the ideal percentage of dilution is depends upon the funding what you need and the value of the company. Very simple, very straightforward.
Right. Right. Great. I think this is a very simple yardstick to look at the valuation and the dilution of equity. I guess this has been the most, simplified way of looking at valuation. I think when we talk about valuation, there is so much going on. There is a lot of emotional aspect of, valuating the company for a founder because he's put his heart and soul and blood and sweat. And there is the emotional aspect. But looking at the numbers is also very crucial. And Satish, I think I should really specifically mention that you have simplified, you have given such simple answers to all the complicated questions that we have been getting over a period of time, that it makes valuation, looking at valuation as a simple exercise. So thank you so much.
Thank
And as
you.
I said, that there has been a little lag in terms of when we are speaking and the questions and the streaming. So for any future questions, we'll drop you an email. And to all the participants who are here live and want to ask Satish any questions, feel free to keep commenting on the live session and we'll get them answered. Uh, but apart from that, if you're not following Satish on LinkedIn, please follow him. I follow him and I read a lot. And these are some really useful tips and compliance inputs that he gives all the times for startups. His company is also responsible for due diligence of investment, so he has perspective of both the ends. And if you're looking for a service of an or expertise like Satish, do get in touch with him through his LinkedIn profile or the email that we are sharing with you. With this, we wrap up episode 6 with Satish, who's virtual CFO of eAuditor Office. And this has been a brilliant, brilliant session. Thank you so much, Satish.
Yeah.
Everybody have a great weekend. And Satish, if you want to say any parting words, please do share it with our
Yeah,
audience.
sure. Thank you, Trisha, for this wonderful hosting this wonderful session. And my dear entrepreneurs, please focus on the process. Don't focus on the results. Okay, definitely you can achieve that target. And also, please, please don't ignore the financial department of your company. and also the compliances, because all our ultimate goal is solving some problem and making money. So the last goal, what is the ultimate goal, is making money one day, making the numbers good. But we are ignoring that department only. So focus on it. So definitely you can achieve great heights. Thank you so much.
Thank you, Satish, for those last inspiring words. With this, we close the session. Have a great weekend, everyone.